This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to The Deep Dive. Today, we're plunging into a topic that, it's fundamentally reshaped the tax and regulatory landscape right across Europe. And Luxembourg is really at its epicenter. We're talking about the Directive on Administrative Cooperation number 6, or DC6 as it's widely known.
That's right.
Now, this isn't just about ticking boxes, is it? It's become a strategic imperative for, anyone operating in legal, financial services, corporate governance, or compliance.
Absolutely.
So for you, our listener, getting a quick yet thorough grasp of its complexities isn't just an advantage, it's really essential these days.
And our mission for this deep dive is precisely that, to give you that shortcut. We're going to distill the foundational law, unpack the critical hallmarks that actually trigger reporting, navigate the, let's say, intricate compliance requirements, and also highlight the strategic opportunities that have emerged from it all.
Think of it as your essential guide.
Exactly. Mastering DAC, not just efficiently, but, with real insight.
That's the goal. We want to deliver those aha moments, the ones that clarify what's truly important and, frankly, why you should care. So, by the end of this deep dive, you'll have 3 key takeaways firmly in mind. Each one has pretty profound practical consequences and strategic value for your operations.
And this is where it gets really interesting.
Yes. First, we'll zero in on that landmark ruling from the Court of Justice of the European Union, CJEU, in case C69420U. It's fundamentally reshaped the whole DAC6 landscape, especially around legal professional privilege, or LPP.
A huge decision.
Huge.
Yeah.
Second, we'll show you why the Administration de Contribution du DAC, that's the ACD, why their frequently asked questions document is, for all practical purposes, the definitive guide for DAC6 here in the Grand Duchy.
You really can't operate without it.
Absolutely not. And third, we'll explore how sophisticated, tech-enabled, and proactive DAC6 compliance has kind of transformed. It's gone from being just a cost center to a powerful, unique selling proposition for advisors, and frankly, a cornerstone of robust risk management for taxpayers. Ready to dive in?
Let's do it.
Okay, let's start by peeling back the layers of DAC6 itself, its core directive, this whole architecture of transparency. Where did it actually come from? What was the EU trying to achieve?
Well, what you said, DAC6 didn't just appear out of thin air. It's really a calculated response from the European Union to increasingly sophisticated cross-border tax planning structures.
Right.
These arrangements were seen, rightly or wrongly, as eroding the tax bases of member states. Its origins lie firmly in that post-base erosion and profit shifting, or BEPS, era. That really kicked off a new global push for, tax transparency.
So if the why was about stopping this perceived tax erosion, what's DAC6's specific objective? What's its stated purpose?
Okay, so according to the European Commission, DAC6 is designed as an early alert system for national tax authorities. The goal is basically to get comprehensive information about potentially aggressive tax arrangements before they're widely implemented.
Proactive.
Exactly. It allows authorities to react quickly, maybe close legislative loopholes, and conduct more effective risk assessments and audits. It's a fundamental shift from just, looking back at past transactions, forensic analysis, to proactive surveillance of current tax plans, all about getting ahead of the curve.
That proactive approach sounds, significant. And when we talk about the legal instruments, what's the foundation here, both at the European and Luxembourgish levels?
Okay, so at the European level, the bedrock is Council Directive 2018/8022. That amended the broader Directive on Administrative Cooperation, which is 2011-16 EU.
Right.
Here in Luxembourg, this was transposed into national law by the Loi du 25 Mars 2020. People often just call it the DC6 law.
Simple enough.
Well, what's important here is Luxembourg's choice to transpose the directive almost verbatim, word for word practically.
And the consequence of that.
It means interpretations and court rulings from the EU level, like the CJEU one we mentioned, have direct and immediate relevance for compliance right here in Luxembourg. You simply can't read the Luxembourg law in isolation. You have to understand it as part of this wider pan-European legal structure.
And I remember there was a bit of a tricky start with its application, wasn't there? Something about looking back.
Absolutely. That was one challenging feature, its retroactive application. While the formal reporting actually began on the 1st of July, 2020, It covered arrangements where the very first step of implementation occurred on or after the 25th of June, 2018.
Wow, that's quite a look back.
It meant a significant look-back exercise for everyone involved. Definitely added an initial layer of complexity.
Okay, so we've covered the why and the what. Let's talk about the who. Who are the key players?
Yeah.
Who actually has reporting obligations under DAC 6?
Right, the DAC 6 framework identifies two principal actors. You've got the intermediary and you've got the relevant taxpayer.
Okay.
And the definition of intermediary is deliberately broad. It casts a very, very wide net. It includes what they call primary intermediaries, essentially the promoters, the ones who design, market, or manage these reportable cross-border arrangements.
The architects, so to speak.
Exactly. But then it also covers secondary intermediaries. These are service providers who simply provide aid, assistance, or advice. And this is the key phrase, could be reasonably expected to know they are involved.
That could be reasonably expected to know. Phrase sounds like it sweeps in quite a few players, especially in Luxembourg's financial sector. Can you give us some examples?
Oh, it absolutely does. This definition sweeps in a vast range of actors you'd find right here. We're talking tax advisors, lawyers, accountants, banks, fund management companies, domiciliation agents. The list goes on.
So how do you qualify as a Luxembourg intermediary then?
You need a sufficient nexus. That could mean being resident for tax purposes here, having a permanent establishment in Luxembourg, being incorporated here, or even just being registered with a relevant professional association.
Got it. And then there's the relevant taxpayer. Who are they?
That's basically any person could be an individual or a company to whom a reportable cross-border arrangement is made available, or who is ready to implement it, or, who has actually implemented the first step.
Okay, so when does the reporting obligation fall on the taxpayer instead of an intermediary?
There are two main scenarios. First is simply when there's no qualifying intermediary involved at all. Maybe think of a structure designed entirely in-house by a company.
Right.
Second, and this is crucial for our market, is when all the intermediaries involved are exempt from reporting because of legal professional privilege, LPP.
Okay, and this brings us nicely to that significant Luxembourgish nuance we mentioned earlier, the impact of legal professional privilege, LPP, and that seismic shift caused by the Court of Justice of the European Union, the CJEU. Walk us through that whole development.
Okay, so initially, Luxembourg's DAC 6 law did recognize professional secrecy. It waived the primary reporting obligation for certain regulated professions, lawyers, chartered accountants, reviseurs d'entreprise, statutory auditors, experts comptables, when they were bound by that secrecy.
But they still had some obligation.
Yes, they had a secondary obligation.
Yeah.
They had to notify other intermediaries involved or notify the relevant taxpayer about the reporting requirement.
Okay, a notification duty.
Precisely. But this, let's call it delicate balance, was completely shattered by the CJEU's decision on the 8th of December, 2022. That was case C69420, the Ord van Vlaam's Billies case.
Right, the Belgian Bar Association case. What was the CJEU's core finding there? What did they object to?
The court ruled that forcing a lawyer to notify other intermediaries, not their client, but other intermediaries, constituted an unjustified interference with the right to respect for private life and communications. That's protected by Article 7 of the EU Charter of Fundamental Rights.
That's fascinating. So the court prioritized fundamental rights over the notification mechanism.
Essentially, yes. What's fascinating here is how the court weighed things up. They found that this specific notification obligation to other intermediaries wasn't strictly necessary to achieve the directive's aim, because those other intermediaries or the taxpayer themselves would still have their own independent reporting obligation anyway.
I see. And how did Luxembourg react to that ruling? Swiftly.
Very swiftly. The Luxembourg Bar issued circular number 001-202-2023 almost immediately. It limited a Luxembourg lawyer's notification obligation strictly to their own client regarding reporting duties. And importantly, this change has also been incorporated into the tax authorities, the ACD's official guidance.
So let's get practical. What does this actually mean on the ground? What are the real profound consequences of the CJEU decision, especially for those non-lawyer intermediaries? Banks, administrators.
Well, it creates a significant operational and, frankly, risk asymmetry. Non-lawyer intermediaries, think fund administrators, banks, accountants, perhaps they can no longer just sit back passively and wait for a lawyer to notify them.
Right.
They now bear full, independent, and proactive responsibility to identify and report arrangements themselves. This substantially increases their direct liability exposure.
And the flip side for law firms?
Conversely, for law firms, their judicially reinforced LPP shield has become an even more powerful, unique selling point. It offers a level of confidentiality for advice that other intermediaries simply can't match now.
So it really raises the question, doesn't it? How are these non-lawyer intermediaries adapting their internal processes? Are they ensuring they're proactively identifying potential reportable arrangements now without relying on that notification?
That's the million-dollar question, really. It requires a fundamental shift in mindset and process for many firms.
And just to be crystal clear, which bodies actually supervise DAC in Luxembourg? Is it the CSSF, the financial regulator, or someone else? People might assume CSSF.
That's a common assumption, but no. While the Commission de Surveillance du Secteur Financier, the CSSF, obviously handles related areas like anti-money laundering, they haven't actually issued specific circulars for DAC itself.
So who is it then?
The Administration des Contributions Directes, the ACD, is the sole competent authority for DAC 6 implementation, interpretation, and enforcement in Luxembourg. Full stop.
Okay.
If we connect this to the bigger picture, it really means all roads for DI6 questions, filings, interpretations. They all lead directly to the ACD, not the CSSF.
That's a crucial distinction for everyone to remember. Okay, now let's move to part 2. Really understanding the hallmarks of a reportable arrangement. These are the core criteria, the triggers, that make an arrangement reportable, right?
Precisely. To be reportable, an arrangement must first be cross-border. That's the baseline. Then it must meet at least one hallmark from the 5 categories, which are labeled A through E.
Simple enough. Cross-border plus 1 hallmark.
Almost. Before we dive into the specific categories, we absolutely have to understand the crucial main benefit test, or MBT.
Ah, yes, the MBT. That pops up a lot.
It does. It applies to all hallmarks in categories A and B, and also to certain specific ones in category C. And it's designed to be an objective test. The question is the main benefit, or indeed one of the main benefits that a person can reasonably expect to derive from the arrangement, a tax advantage?
Okay, an objective test. And what's the Luxembourgish take on that? How does the ACD interpret it?
This is where the ACD guidance is absolutely vital. They clarify that the MBT is not met if the tax advantage you get is consistent with the object, the purpose, and importantly, the intention of the legislator behind the applicable law.
So if the law intended that tax outcome, the MBT isn't met.
Broadly, yes. And crucially, the tax advantage must relate specifically to direct taxes, things like income tax, corporate tax, not VAT or other indirect taxes.
Got it. Direct taxes only. Okay, so starting with Category A, generic hallmarks, what are we looking for here, and how does the MBT apply?
Okay, Category A includes hallmarks that are often tied to things like secrecy or success fees. For example, 8.1 involves confidentiality, where the intermediary insists the taxpayer can't disclose how the arrangement secures the tax advantage.
Right.
8.2 applies if the intermediary's fee is contingent on the amount of the tax advantage actually achieved. Or maybe if they have to refund the fee if the advantage doesn't materialize.
Performance fees, basically.
Sort of, yes. And 8.3 covers standardized arrangements. These are structures with standardized documentation or structure available to multiple taxpayers without significant customization. The key here is that all of these 8.1, 8.2, 8.3 require the main benefit test to be met to trigger reporting.
Okay, MBT needed for all of Category A. Then we have Category B, specific hallmarks. What makes these specific, and do they also require the MBT?
Yes, all Category B hallmarks also require the MBT to be satisfied. These are a bit more focused on specific types of tax planning structures. For instance, B1 relates to what's often called loss buying. Contrived steps taken to acquire a loss-making company, use its losses to reduce tax liability, and then discontinue its main business.
Okay.
B.2 deals with income conversion, converting income into capital, gifts, or other lower taxed or exempt categories. And B.3 involves circular transactions. Think of funds round-tripping flowing through interposed entities that lack primary commercial function, or transactions that offset or cancel each other out. These often look like attempts to manipulate structures purely for tax purposes.
Right, more specific structures, but still need that MBT link. Now, moving to Category C, specific hallmarks related to cross-border transactions. I understand some here require the MBT and some don't. Which one is a frequent trigger in practice?
C1, which deals with deductible cross-border payments, is a very frequent trigger point, definitely. It applies to deductible payments made between associated enterprises across borders, but only if certain conditions are met regarding the recipient.
Such as?
Such as the recipient not being tax resident anywhere, or being resident in a jurisdiction that's on a non-cooperative list. Or, and this is common, being resident in a jurisdiction with a 0 or near 0 corporate tax rate, or one that grants a full tax exemption for the payment, or benefits from a preferential tax regime.
Okay, several conditions there. Does the MBT apply to all of those?
This is where the ACD guidance gets specific again.
Yeah.
The ACD clarifies how to determine tax residency, usually based on double tax treaties or the OECD Model Tax Convention. And crucially, the MBT does apply if the trigger is the near zero rate, the full tax exemption, or the preferential regime. However, the MBT does not apply if the trigger is the recipient being on a non-cooperative list or not resident anywhere.
That's a key nuance. MBT applies sometimes in C.1, sometimes not. What about other C hallmarks?
Right? Other hallmarks in Category C, like C.2, which covers claiming depreciation on the same asset in multiple jurisdictions, or C.3, dealing with claiming double tax relief for the same income or capital in multiple jurisdictions, or C.4 asset transfers with mismatched valuations, these generally do not require the MBT to be met.
Okay, clearer now. In Category D, the one concerning automatic exchange of information, or AEOI, and beneficial ownership, no MBT for these either, correct?
That's absolutely right. No MBT needed for Category D, D1 is all about arrangements that might undermine reporting under AEOI rules, like the Common Reporting Standard, CRS. This could involve using accounts or investments not subject to AEOI, or transferring assets to such accounts, or maybe reclassifying income or capital into categories not covered by AEOI.
So trying to sidestep CRS, essentially.
Basically, yes. And D.2 targets arrangements designed to obscure beneficial ownership. This involves using non-transparent legal or beneficial ownership chains, often involving entities or structures in third countries that don't ensure transparency, or using persons or structures that lack substantive economic activity. Essentially, arrangements that make it difficult to see who truly owns or controls assets or income. These are crucial for overall financial transparency efforts, regardless of any direct tax benefit.
Makes sense. Finally, Category E specific hallmarks concerning transfer pricing. Also, no MBT here, you mentioned.
Direct. No MBT for Category E. These are focused purely on transfer pricing practices. E.1 covers the use of unilateral safe harbors, domestic rules that allow for simplified pricing for certain intergroup transactions, bypassing detailed comparability analysis. E.2 deals with transfers of hard-to-value intangibles. These are defined quite specifically as intangibles where, at the time of transfer between associated enterprises, there are no reliable comparable transactions available, and the projections of future cash flows or income are highly uncertain, making valuation tricky. Think about unique patents or algorithms moving within a group.
Right, ensuring fair value for those tricky assets. And what about E.3? That's the intragroup transfer of functions, risks, or assets. That's triggered if the transfer's projected annual earnings before interest and taxes EBIT drops significantly after the transfer, right?
Yes, specifically if the transfer's projected annual EBIT during the 3-year period after the transfer is less than 50% of what its projected annual EBIT would have been had the transfer not occurred.
That sounds quite specific. Any guidance on that?
Yes, and crucially, the ACD's guidance for E.3 is very precise and important. First, they state the transfer must involve a legal change of ownership or assumption of risk function. This means, for instance, that simple corporate migrations where the company maintains its legal personality are considered out of scope for E.3.
Ah, okay.
Yeah.
That's a big clarification.
It is. And the ACD also provides a specific formula for calculating that EBIT reduction, linking it directly to accounts in Luxembourg's standard chart of accounts, Plan Capital Normalisé. This just reinforces the point we made earlier. The ACD's FAQ document isn't just guidance, it's truly the operational rulebook for DAC C6 and the Grand Duchy. Understanding its specific nuances, like for E.3, is absolutely vital for correct application.
So after that whirlwind tour of the hallmarks, what's the real takeaway? It sounds like there are just so many potential triggers, some quite technical.
I think the key takeaway isn't just memorizing each category, though that's helpful. It's really understanding the sheer breadth and reach of DAC 6. Even seemingly standard or, let's say, innocuous cross-border transactions can potentially trigger a reporting obligation, especially given how broadly the main benefit test can apply in some cases, and considering the very specific interpretations provided by the ACD on things like Category C or E.
So vigilance is key.
Absolutely. This is precisely why having a thorough, systematic internal review process for cross-border activities is so essential for both intermediaries and taxpayers. You need to screen transactions against these hallmarks proactively.
All right, that makes perfect sense. Let's transition now to Part 3, the art and science of compliance. So you've gone through your checks, you've identified a reportable arrangement. What exactly do you need to disclose to the authorities? What information are they looking for?
Okay, the what to disclose is pretty extensive. It's designed, as you'd expect, to provide a comprehensive overview to the tax authorities. You need to include the full identities, names, addresses, TINs, etc., of all the intermediaries involved and all the relevant taxpayers.
Right.
Then, details of the specific hallmark or hallmarks that were triggered. A summary of the arrangement itself, and this needs careful drafting to give enough detail without necessarily disclosing confidential commercial, industrial, or professional secrets or trade processes.
A balancing act there.
Definitely. You also need the date on which the first step in implementing the arrangement was made or is intended to be made. You need to identify the relevant national legal provisions that form the basis of the arrangement, the actual value of the arrangement.
The value, okay.
And finally, identify all the other EU member states likely to be concerned by the arrangement and any other persons in those states likely to be affected. It's a lot of data points.
It certainly sounds like it. And how is all this actually reported? Is it still paper forms or is it all electronic now?
No, it's entirely electronic now. It all goes through the myguichet.ugri platform. To use it, you need a Lux Trust certificate or an electronic identity card, an EID.
Okay, standard Luxembourg practice.
Pretty much. And you have two main submission methods within myguichet. You can either fill out an online form directly, or you can prepare the data in a specific format, an XML file, and upload that.
And what happens after you submit? Do you get confirmation?
Yes, that's important. Once the filing is successfully submitted and validated by the ACD system, it generates unique reference numbers. There's an arrangement reference number, ARN, for the specific arrangement, and a disclosure reference number, DRN, for that particular filing. These serve as proof of filing.
And what does the taxpayer do with those numbers?
The relevant taxpayer must then reference these ID numbers, the ARN and DRN, in their annual tax returns for every year that the arrangement is in use or produces effects. It links the reporting to the taxpayer's file.
Okay, clear process. Now, it sounds like compliance has become a really hot topic in contractual negotiations, too. You mentioned risk allocation. We're seeing a lot of DAC 6 clauses popping up in commercial and financial contracts now, aren't we?
Oh, absolutely. DAC 6 clauses are pretty much standard now in any significant cross-border deal. And yes, they have become a new battleground, if you like, for risk allocation between parties.
What do these clauses typically cover?
They usually fall into a few main categories. You'll see representations and warranties where parties state whether they believe an arrangement is reportable or not. You'll find information covenants, obliging parties to share necessary information for reporting. And crucially, you'll see clauses dealing with reporting responsibility and indemnification, basically. Who takes the lead on reporting and who covers the cost or penalties if something goes wrong.
And has that CJEU ruling on LPP affected these negotiations?
Definitely. The post-CJEU landscape has really intensified these negotiations.
Yeah.
It's turned DT6 into a significant contractual liability issue. Non-lawyer intermediaries, knowing they now have that primary non-delegable responsibility in many cases, are now much more assertive in demanding robust information sharing commitments and, importantly, indemnities from their clients or other parties, given their heightened direct responsibility and potential penalties.
Speaking of penalties, this sounds like it could get costly if you get it wrong. What about the actual cost of compliance itself, and how does that influence, say, legal pricing in this area?
Well, the direct penalty for non-compliance or incorrect or late filing is significant. The ACD can impose fines of up to 250,000 euros per infringement.
Wow, per infringement, that's steep.
It certainly focuses the mind. This high-stakes environment has naturally led to quite sophisticated legal and advisory pricing models for DTAC 6 work. You see fixed-fee arrangements for specific reviews, traditional time-based billing, retainer or subscription models for ongoing support, and increasingly, value-based pricing that reflects the significant risk being managed and the immense value of getting expert guidance to avoid those hefty fines.
Understandable. And finally, on the compliance practicalities, those timelines and triggers, that 30-day countdown, seems incredibly tight, almost brutal.
It is brutal, and the authorities, including the ACD, are known to enforce it strictly. That 30-day clock starts ticking from the earliest of several trigger events. The day after the arrangement is made available for implementation, or the day after it's ready for implementation, or when the very first step of implementation is actually taken.
And for those secondary intermediaries, the ones providing aid or advice?
For them, the clock starts the day after they provide their aid, assistance, or advice. Given these tight deadlines and multiple potential triggers, it absolutely necessitates having a robust, ideally real-time, identification and tracking system within organizations. You simply cannot afford to let one slip through the net and miss that 30-day deadline.
A real operational challenge. Okay, let's shift perspective now to part 4. The unique selling proposition, or USP. It sounds like DK6 compliance has evolved beyond just, ticking the necessary boxes. It's become a strategic differentiator. How so?
Well, I think the core USP, certainly for the premium advisors, is the move away from purely reactive reporting towards proactive risk management. The most valuable advisors today aren't just helping file reports after the fact. They're getting involved much earlier, at the design stages of transactions.
How does that help?
They help clients structure deals in a way that perhaps avoids triggering certain hallmarks unnecessarily, or at least understands and manages the reporting consequences from the outset. It's about embedding compliance thinking right into the client's workflows and deal processes. This raises an important question for businesses. How can you truly integrate DAC6 risk management into your core business development and transaction planning, rather than treating it as a separate reactive compliance task tacked on at the end?
That proactive approach certainly sounds like a significant value add for clients. What other differentiators are emerging in the advisory market?
Another key one is taking a holistic approach. This means advisors who can connect the dots, integrating DAC6 advice with related areas like anti-money laundering rules, the EU's anti-tax avoidance directives ATAD 1, 2, and soon 3, and other transparency initiatives like beneficial ownership registers or Pillar 2. Clients want joined-up thinking.
Makes sense. Technology must play a role, too.
Absolutely critical. Technological sophistication is a major differentiator. Leading firms are offering dedicated platforms or tools for tracking potential arrangements, analyzing hallmark triggers, managing workflows, generating reports, and crucially, maintaining robust audit trails. Automation helps manage the volume and complexity. And alongside tech, deep specialization, especially in really complex areas like the Category E transfer pricing hallmarks, is highly valued.
And circling back to the law firms, that LPP shield, now reinforced by the CJEU decision, must be their most powerful and unique selling proposition in this space.
Without a doubt. For advice covered by LPP, it offers a level of confidentiality that other intermediaries simply cannot match. It's a distinct, legally protected advantage in today's transparency-focused landscape.
So what's the upshot of all this?
I think it means the DA6 advisory market has clearly stratified. You have a premium tier emerging, offering not just compliance, but genuine risk mitigation, strategic insight, operational efficiency through tech, and where applicable, that LPP confidentiality. This makes the choice of advisor not just a cost decision, but a truly strategic business decision for companies navigating DAC6.
Very clear. Finally, let's look ahead briefly to part 5, what's on the horizon. It sounds like the world of tax transparency is anything but static. We shouldn't expect things to stand still.
Definitely not. It's an incredibly dynamic field, so continuous vigilance is absolutely essential. For one thing, the ACD's own guidance, primarily through its FAQ document, is not static. It gets updated periodically as new questions arise or interpretations evolve, so continuous monitoring of that ACD guidance is just a must.
Okay, keep watching the ACD. What else? Other directives?
Well, we're seeing the continued evolution of administrative cooperation. For instance, DTA 8 is now finalized, focusing mainly on the reporting and exchange of information related to crypto assets. While it also includes some general refinements to administrative cooperation processes, the core principles of D6, and importantly, the CJEU's ruling on LPP for lawyers, seem secure for now. But it shows the direction of travel, more data exchange, more transparency.
So if the rules themselves might see incremental changes, what's the biggest upcoming development that market participants should really be watching for regarding D6 specifically?
I think without a doubt the next major phase is enforcement. The initial years of D6 were largely about setting up the systems and collecting the data, that early alert phase. Now, the tax authorities across Europe, including the ACD, have amassed a vast data set of reported arrangements.
And now they'll start using it.
Exactly. The focus is inevitably shifting from collection to active data analysis and utilization. We predict, and I think this is a safe prediction, a future wave of more targeted tax audits and investigations, with authorities using the DAC6 data as a key source for risk assessment and identifying potential non-compliance or aggressive planning. So what does this all mean for you, the listener? It means the information filed is not just sitting in a database, it's likely to be actively used.
That's a sobering thought. Okay, as we draw our discussion to a close, let's quickly reinforce those 3 essential takeaways from today's deep dive into DAC6 in Luxembourg. First, that landmark CJEU ruling on legal professional privilege. It fundamentally redrew the responsibility lines. Yes, it fortified the confidential nature of legal advice, which is a key USP for law firms. But simultaneously, it significantly increased the compliance burden and the direct risk exposure for all other intermediaries, banks, administrators, advisors, etc. They are now squarely in the hot seat.
Couldn't agree more.
Second takeaway. Here in the Grand Duchy, the ACD's frequently asked questions document is, quite simply, the non-negotiable operational manual for DAC 6. Trying to ensure compliance without constantly referring to and understanding the nuances in that FAQ document is, frankly, a perilous endeavor. It dictates how things work on the ground.
It's the rule book.
It is the rulebook. And third, mastering DAC 6, understanding it, implementing robust processes, maybe leveraging technology has become a true strategic advantage. It transforms compliance from being seen as just a burdensome cost center into a powerful differentiator for advisors and for taxpayers. It's a critical tool that builds trust with authorities and proactively mitigates significant financial and reputational risk.
Absolutely. And perhaps to leave you with a final provocative thought to consider. Think about how proactive and sophisticated compliance today can fundamentally shape your future business opportunities and resilience. By embedding DAC 6 compliance not as a burden, but as a strategic asset integrated into your governance, your risk management, your transaction planning, you can not only navigate the current regulations more effectively, but also potentially reduce unexpected challenges down the road. You build a more resilient, transparent, and ultimately trustworthy operation in what is an increasingly demanding global tax landscape. So the question is, how can your own internal processes become less of a compliance headache and more of a genuine strategic advantage?
A great question to ponder. This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Hit that like and subscribe button. It was the deep dive for you today.